Ontario will once again be home to the next link in Canada's growing electric vehicle supply chain.
What if the very trade war that promised to save American factories is now accelerating their collapse while Canada quietly captures the investment, the jobs, and the future of North American manufacturing? Today's analysis begins with a hard reality confronting the United States. Tariffs were sold as a shield, protect workers, bring production home, and restore industrial strength. But across factory towns and boardrooms, a different picture is emerging. Manufacturing activity in the United States has weakened month after month. Costs have climbed, and communities built on industrial payrolls are absorbing the shock. At the same time, Canada is landing multi-billion-dollar industrial projects tied to electric vehicles, batteries, and critical materials projects global firms once considered building south of the border. This is not a partisan argument. It is a question of outcomes. When tariffs raise input costs for domestic producers, investment decisions shift. When policy becomes unpredictable, capital looks for stability. And in a trade war, the winners are rarely obvious until the data forces a reckoning. Here is the central tension we will unpack tonight. While the United States wrestles with factory closures and price pressure, Canada is positioning itself as the predictable alternative for global supply chains. In the United States, manufacturing output contracted for most of the past year. Public economic data show that factory activity declined for more than half a year in a row, a pattern historically associated with recessionary pressure in industrial regions. During the same period, more than 42,000 manufacturing jobs disappeared nationwide within months of the tariff escalation, not over decades, but within a single policy cycle. These were not abstract losses. They were concentrated in machinery, metals, and transportation equipment sectors that rely heavily on imported inputs now subject to tariffs. At the same time, producer costs in the United States rose sharply. Steel and aluminum prices climbed into double-digit increases after tariffs were imposed, forcing manufacturers to choose between absorbing losses, raising prices, or relocating production stages abroad. For small and mid-sized factories, margins proved too thin. Plant closures followed. Local tax bases shrank. Municipal budgets tightened. In manufacturing towns, one factory closure often translated into thousands of indirect job losses across logistics, retail, and services. Now look north. In Canada, foreign direct investment into advanced manufacturing rebounded sharply. In Ontario alone, confirmed electric vehicle and battery supply chain projects exceeded $10 billion United States dollars in committed capital over a 2-year window. One single battery facility project reached $7 billion United States dollars, ranking among the largest industrial investments in Canadian history. Critical minerals processing and agricultural expansion projects added several billion more, particularly in Western Canada. Canada's export performance reflected the shift. Non-energy merchandise exports grew steadily as companies rerouted supply chains to avoid tariff exposure. Global firms cited one factor repeatedly in public filings and earnings calls: predictability. While the United States adjusted tariff lists, exemptions, and retaliatory measures, Canada offered continuity under existing trade frameworks. The result was a widening divergence. Manufacturing investment in the United States slowed as capital expenditure plans were postponed or canceled. In Canada, factory construction permits, equipment imports, and skilled labor demand moved in the opposite direction. This is the hidden cost of a trade war rarely discussed on the campaign trail. Tariffs do not simply punish foreign producers. They reshape where the next factory is built, where the next worker is hired, and which country controls the next generation of industrial capacity. And what follows is the breaking point. Washington tried to bury the moment. Rising prices forced a quiet retreat, exposing that this trade war was no longer a strategy, but a liability the United States could not afford to admit. The decisive damage from this trade war did not begin with headlines about factories or boardrooms. It began when higher costs reached American households and refused to stay hidden. As tariffs expanded across supply chains, consumer prices followed with unusual speed. Food prices became the first clear warning sign. Public economic data show grocery inflation accelerating well beyond long-term averages, with staples such as meat, fresh produce, and packaged foods rising faster than wages for much of the year. For retirees, veterans, and middle-income families on fixed or predictable incomes, these increases were not temporary inconveniences, they were structural shocks to monthly budgets. This is where the theory behind tariffs collided with reality. Tariffs were framed as costs imposed on foreign producers. In practice, importers inside the United States paid first, distributors absorbed pressure next, and consumers covered the remainder at checkout counters. Food supply chains amplified the effect because demand could not be postponed. Families adjusted not by buying less food, but by cutting spending elsewhere. That adjustment rippled outward. Consumer confidence weakened. Retail margins tightened. Local governments already strained by factory closures saw demand rise for food assistance and social services, even as sales tax growth slowed. This combination of higher living costs and weakening revenue historically signals economic stress that spreads faster than unemployment statistics alone. Behind the scenes, political concern intensified. Retailers, food processors, and agricultural distributors delivered blunt warnings to policymakers. Food inflation moves faster than industrial recovery. Voters tolerate abstract economic pain unevenly, but grocery prices are immediate, visible, and emotionally charged. When food costs rise, political capital erodes quickly, regardless of ideology. The trade war had reached the one place no administration can ignore for long, the household balance sheet. And that pressure set the stage for a decision Washington did not want to explain. Without public acknowledgement or formal reversal, Washington quietly began removing tariffs on selected food imports. Beef, tomatoes, bananas. No primetime announcement, no admission of error. Just a recalibration that contradicted months of assurances that tariffs were harmless to American consumers. This shift mattered far beyond the grocery aisle. If tariffs truly imposed no domestic cost, there would have been no need to lift them where voters feel pain most directly. The rollback exposed a limit Washington had reached but could not publicly admit. Price tolerance had been exhausted. The trade war had crossed from strategic pressure into political liability. Markets noticed immediately. In global trade, quiet reversals are louder than speeches. They signal vulnerability. They tell investors that policy is reactive, not anchored. Multinational firms planning long-term investments read this moment as confirmation that future tariff policy could change abruptly under consumer pressure. That perception reshaped decision-making. While Washington adjusted under inflation stress, Canada emphasized continuity. Trade frameworks remained stable. Agricultural exports flowed without sudden policy shocks. For global firms weighing where to expand processing, warehousing, and advanced manufacturing, the contrast sharpened. One market oscillated under domestic pressure, the other projected predictability. Supply chains responded accordingly. Import routes shifted to minimize tariff exposure. Value-added processing increasingly occurred outside the United States before goods re-entered global markets. These decisions were not ideological. They were financial. Capital moved quietly, without waiting for official confirmation. Inside the United States, the contradiction deepened. If food tariffs could be removed without threatening national security, why were other sectors still absorbing the cost? And if partial rollbacks were necessary to protect consumers, what did that say about the durability of the broader trade war strategy? Economists warn that partial retreats create the worst possible environment. Uncertainty without relief, businesses hesitate, consumers brace for the next increase, trading partners hedge against future reversals. Policy loses credibility, even where intentions remain firm. This was no longer a debate about trade theory. It was a question of trust. And in the next part, we will expose how this silent retreat triggered a far more dangerous consequence, because once global partners began questioning Washington's reliability, Canada was ready with an alternative that reshaped North American trade in ways few Americans saw coming. Once the quiet tariff rollback became visible to markets, the trade war entered a new and more dangerous phase. The credibility phase. In global commerce, consistency matters as much as cost. Multinational companies plan factories, logistics hubs, and supply contracts years in advance. They tolerate higher wages and stricter regulations if the rules are stable. What they cannot tolerate is uncertainty. And during this phase of the trade war, uncertainty increasingly defined the United States. Corporate disclosures and investment briefings during this period showed a clear shift in tone. Executives stopped debating whether tariffs were good or bad in theory. Instead, they asked a more practical question. How long would current tariff rules last before the next adjustment? That question alone was enough to delay decisions worth billions of dollars. Capital expenditure plans slowed. Some projects were postponed indefinitely. Others were redesigned to minimize exposure to United States tariff risk. This was especially visible in sectors tied to complex cross-border supply chains, such as automotive manufacturing, machinery, electronics, and agricultural processing. For global firms, the trade war began to look less like a strategy and more like a variable they could not model. Financial markets responded accordingly. Risk premiums rose for United States manufacturing investments dependent on imported components. Currency and commodity traders priced in volatility. Even allied governments quietly began advising domestic companies to diversify export routes and production locations in case Washington altered tariff policy, again under political pressure. This is how trade influence erodes. Not through a single announcement, but through accumulation of doubt. The most damaging signal was not the tariffs themselves. It was the reversal. When food tariffs were lifted without explanation, the message to the world was clear. Domestic price pressure could override trade policy at any moment. That realization changed how foreign partners evaluated long-term exposure to the United States market. In a trade war, perception often becomes reality. And while Washington grappled with that perception, another country was preparing to benefit from it. While the United States adjusted policy under internal strain, Canada pursued a different approach. There were no dramatic speeches, no retaliatory escalation designed for headlines. Instead, Canadian trade policy emphasized continuity, predictability, and quiet engagement with global investors. This approach resonated. Foreign direct investment into Canadian advanced manufacturing accelerated, particularly in sectors aligned with long-term global demand: electric vehicle batteries, critical minerals processing, agri-food infrastructure, and logistics. Projects announced in Ontario and Western Canada were not speculative. They were capital-intensive, multi-year commitments that signal confidence in policy stability. Global firms repeatedly cited the same rationale in public statements and earnings calls. Canada offered reliable trade access, clear regulatory timelines, and fewer abrupt policy shifts. In a trade war, those traits function as economic shelter. Canada also benefited from geography. Integrated North American supply chains allowed companies to shift portions of production north without abandoning the continental market. Processing, assembly, and value-added manufacturing could occur in Canada, reducing tariff exposure before products entered global distribution networks. This was not a confrontation, it was an absorption. Agricultural exporters followed a similar pattern. As tariff uncertainty complicated United States sourcing, Canadian agri-food processors expanded capacity to serve both domestic and international demand. Grain handling, fertilizer logistics, and food processing investments increased, particularly in provinces with direct rail and port access to global markets. The result was a quiet rebalancing. Canada did not win the trade war by defeating the United States. It benefited by remaining predictable while Washington became reactive. In trade economics, that distinction matters more than rhetoric. For American policymakers, this created an uncomfortable reality. The trade war had not isolated rivals alone. It had also introduced friction within North America itself. Supply chains that once defaulted to United States hubs were now routing elsewhere, not out of hostility, but out of risk management. This shift does not reverse easily. Once companies invest billions of dollars into facilities, they do not move them back on campaign promises. Infrastructure decisions tend to outlast political cycles. And that raises the most consequential question yet. Because in the next part, we will examine the long-term implications of this shift, why the trade war may have altered North American manufacturing geography in ways that persist long after tariffs are lifted, and what that means for jobs, wages, and economic power inside the United States. By this stage, the trade war is no longer primarily about tariffs on paper. It is about physical decisions already made, factories built, supply chains rerouted, capital locked into place. Manufacturing geography changes slowly, but once it changes, it rarely snaps back. When companies commit billions of dollars to a battery plant, a processing hub, or a logistics corridor, they design operations to run for decades, not election cycles. That is the structural risk now confronting the United States. Industrial investment data show a widening gap between announced projects and completed construction south of the border. Even when companies express interest in reshoring, many delay final commitments, citing cost uncertainty and policy volatility. In contrast, facilities announced in Canada are moving from planning into construction, workforce recruitment, and supplier contracting. This matters because industrial ecosystems compound over time. A factory does not stand alone. It pulls in parts suppliers, maintenance contractors, logistics firms, training programs, and local infrastructure upgrades. When that ecosystem forms in one country instead of another, the long-term employment and wage effects follow it. Once suppliers cluster around a Canadian facility, moving them back to the United States becomes exponentially more expensive. This is the quiet cost of the trade war. The tariffs were designed to pressure foreign producers. Instead, they introduced friction inside North America itself. Firms responded rationally, not politically. They chose locations where costs could be modeled, regulations forecasted, and trade access preserved. Stability became the deciding variable. For American workers, this creates a delayed but serious consequence. Jobs are not always lost immediately. Often, they are never created in the first place. Communities waiting for the next factory simply never see it arrive. And that absence rarely makes headlines. From a strategic standpoint, the greatest danger of this trade war is not short-term disruption. It is erosion of credibility. Once allies and investors begin planning around the assumption that United States trade policy may shift suddenly under domestic pressure, they adjust permanently. Contracts are written differently. Supply chains diversify. Capital spreads across jurisdictions. Influence weakens quietly. For decades, the United States benefited from being the default hub of North American manufacturing and trade. That status did not depend solely on size or power. It depended on reliability. When reliability comes into question, even partially, alternatives gain traction. Canada did not need to confront Washington to benefit. It only needed to remain consistent. This creates a paradox for United States policymakers. If tariffs are rolled back too slowly, consumer pressure intensifies. If they are rolled back too quickly, credibility collapses. Either path carries political and economic cost. And because industrial investment timelines stretch far beyond a single administration, even a full policy reversal may not restore lost momentum. There is also a global dimension. Other trading partners are watching closely. If the United States can quietly retreat on food tariffs under inflation pressure, they ask a simple question: what happens when the next price spike hits? That uncertainty encourages diversification away from reliance on the United States market altogether. In this sense, the trade war risks achieving the opposite of its stated goal. Instead of pulling production inward, it encourages dispersion. Instead of consolidating influence, it dilutes it. The question now is not whether tariffs can be adjusted. It is whether the damage to trust can be repaired. Because once global capital decides that stability exists elsewhere, it does not wait for apologies. It builds where confidence feels durable. And in the final part, we will confront the hardest question of all, whether the United States can still reverse course without admitting failure, or whether this trade war has already crossed the threshold where the consequences will outlast the politics that created it. There is a critical assumption behind every trade war, that economic power can be applied like pressure, and that pressure will force others to bend before it causes lasting damage at home. What this case reveals is something far more unsettling for the United States. Power did not disappear. It misfired. The United States still commands the largest consumer market in the world, deep capital pools, and unmatched financial influence. But tariffs transformed those strengths into leverage only on paper. In practice, they exposed a weakness modern economies rarely discuss openly: dependence on global integration. Manufacturing in the United States no longer operates in isolation. Factories rely on international inputs, cross-border logistics, and synchronized supply chains. When tariffs disrupted those networks, the damage did not concentrate overseas. It diffused inward, raising costs, delaying production, and weakening competitiveness from within. This is where the strategy unraveled. Instead of forcing companies to reshore rapidly, the trade war forced them to redesign their exposure. That redesign did not mean abandoning North America. It meant rebalancing it. Processing moved. Assembly shifted. Investment flowed toward locations where trade rules appeared durable rather than politically reactive. This is the moment policymakers underestimated. Tariffs can discourage imports. They cannot compel investment on a fixed timetable. And when investment hesitates, it looks for certainty elsewhere. That is how Canada quietly gained ground, not through confrontation, but through consistency. Once capital adjusts to a new equilibrium, reversing that adjustment becomes extraordinarily difficult. Political announcements cannot relocate factories already under construction. Campaign speeches do not undo supply contracts signed years in advance. This is not a temporary distortion. It is a structural shift, and that realization has begun reshaping how global partners view the United States as a trade anchor. At this stage, Washington faces a narrowing set of options. Doubling down on tariffs risks deeper domestic strain, higher consumer prices, and further erosion of investment confidence. Rolling them back too broadly risks validating the perception that the strategy failed under pressure. Either direction carries cost. What no longer exists is a clean exit. This is the paradox of the current trade war. The policy was framed as strength, but strength, when applied without precision, creates vulnerability. Once allies and investors internalize that United States trade policy may shift abruptly in response to domestic price pressure, they plan accordingly. That planning does not reverse easily. The deeper risk is not economic alone. It is institutional. Trade credibility is cumulative. It builds slowly and erodes quietly. When credibility weakens, influence follows. Partners hedge. Competitors exploit uncertainty. Allies diversify away from dependence. None of this requires a formal break. It happens incrementally, behind closed doors, through spreadsheets rather than speeches. For decades, the United States set the terms of global trade, not only because it was powerful, but because it was predictable. That predictability is now being tested. The question Washington must answer is no longer whether tariffs can pressure others. It is whether the United States can restore confidence without admitting that the strategy crossed a line it cannot uncross. Because if credibility has already shifted, the consequences will not align with election cycles. They will outlast them, and in the final conclusion, we will confront the question few policymakers want asked publicly, whether this trade war has already reshaped North America in ways that the United States cannot fully undo, even if tariffs disappear tomorrow. The most unsettling truth of this trade war is not that it failed to deliver what was promised, but that its consequences may now be unfolding beyond the control of the United States itself. What began as an effort to use tariffs to reclaim manufacturing strength has evolved into something far more complex. Factory closures, rising consumer prices, and quiet policy reversals have collided with a global investment environment that punishes uncertainty. While Washington adjusted under domestic pressure, Canada advanced steadily, absorbing capital, talent, and long-term industrial commitments that do not migrate easily once established. This is not a story of one country winning and another losing overnight. It is a story of momentum. In global trade, momentum compounds. Once supply chains shift, once factories are built, once confidence is reallocated, the map does not simply reset when policies change. That is the risk now facing the United States. The central question remains unresolved. Can this trade war be recalibrated without admitting strategic error? Or has the use of tariffs already altered North American manufacturing in ways that will define the next generation of economic power? And perhaps the most uncomfortable question of all still lingers beneath the surface. If this is what happens when trade policy becomes unpredictable, what other assumptions about economic leadership are quietly being reconsidered right now? Is this a bold strategy or a risky mistake for the United States? Subscribe for more fact-based global analysis.